So I may have gotten a little bit ahead of myself by talking about bargain gifts to charity in the last video because it's one of many other ways that you can give to charities. In addition to bargain gifts, there are also gifts of a split interest. And this is setting up a trust for the purpose of either giving the charity the income from those trust assets, and then you pick another beneficiary to get the remainder, or you keep the income during the life of the trust, and then after you're gone, the charity gets the remainder. Let's talk about the terms and what these terms mean around these split interest gifts. And again, the interest that we're splitting is the income and then the remainder. So if you were to put assets into a trust, you would expect to get some income as a result of that asset, whether it's a rental property or Nike stock. It should be spitting out some income, hopefully. And you're deciding who should get that income. Maybe you can't afford to make this gift outright to a charity. You're like, look, I want a deduction, and I want either the income or I want control of where that asset is going to go to a non-charitable beneficiary at the end. So the only reason you would consider a charitable trust is if you want to control the asset. And even if it's inside of a trust, you can still control the asset in terms of the investment of it and the management of that investment. But you've got to decide, am I going to give the charity the income or am I going to give the charity the remainder benefit? And that's the split interest. And when it comes to taking income, you'll recall from the trust chapter where we talked about GRITs, CRATs, and CRUTs. And that's where, the vowel being the differentiator, the I, the U, or the A. In this case, there is no CRIT or I don't even want to say the other one. Anywho, there's only annuity income or unitrust income. So annuity income means that you're going to get a fixed payment based on the original amount in the trust. Therefore, you can't add any more to the trust. Once you complete it, once you fund it, it's done. You can't add any more to it. And you're just going to take fixed payments out of there, either for yourself. If it's a charitable remainder trust, you get the income. Or if it's a charitable lead trust, the charity gets the income and they get that fixed annuity payment. With a unitrust setup, that goofy unitrust word just refers to a percentage. You decide in advance that the income is going to be based on a percentage of the asset. And every year you have to revalue the assets in the trust to figure out how much the income is going to be that year. It's going to be the same percentage, but as the assets bounce up and down in value, so does the income. So, charitable lead versus charitable remainder. When you see lead, it means that charity is getting the income. When you see remainder, it means the charity is getting the principal at the end.